We're live, so do not swear. That's a joke. We always fucking swear here.
Yeah.
Good afternoon, wherever you are in the world. It's Seller Sessions today. It's the Aggregators Roundtable. Sorry, I just had some fires to put out, so a little bit delayed. Sorry, gentlemen, for keeping you waiting. Okay, so today's show is going to effectively, for a better word, it's a rebuttal to some of the comments from last week. We had someone came in talking about investment bankers buying an Amazon business, which is absolutely fine. And there's a series of opinions there, but I also think it's important that aggregators give their opportunity to speak on some of these key points. I mean, Rob made a list of these items, but before we get into that, can we go around the room and do introductions? And I'll share to the groups and then we'll get started. So starting with you, Rob.
Yeah, hi, Danny. Thanks for setting this up. I'm Rob Bell, the Chief Growth Officer of Elevate Brands, principally responsible for driving forward our business development efforts of the group. I'm from Australia originally and now based in Austin, Texas.
Excellent. Brandon.
Yeah, hey everybody. My name is Brandon Hendricks. I'm the Senior Vice President of Marketing at Thrasio, as a part of the founding team back when we started a while ago. So I run all of the advertising, or my team runs all the advertising for all the brands that we acquire at the end of the day. So all the PPC and Facebook and DSP and direct to consumer and anything paid growth related, the marketing team pretty much takes care of at Thrasio.
Superb. And to Ken.
Yep, Ken Kubak, VP Acquisitions at Thrasio. Similar to Brandon, kind of been here since the beginning. My team is responsible for sourcing all of our acquisitions, negotiating, and signing term sheets.
Sounds good. Right, so let's just get into it. I just want to put up the notes that Rob gave me earlier on today. Guys, did you get a chance to skip through the episode from last week, Brandon and Ken, yeah?
Yep.
So you pretty much know what's coming. So the first thing, and this is, I defended on this as well. Majority of Amazon aggregators are operators and don't get it. So bring it back to Rob's point. When we're talking about it last week, we're talking about people that in the space that know what they do, know what they're doing. And there are people that are raising money that have not got a fucking clue what they're doing. And I'll put you guys in the bracket of the top 10%, i.e. you guys and a few others out there, Perch, etc., do know what they're doing. They've got operational chops. And he was saying that 90% don't. Would you agree of that as a sum? Bearing in mind, I've just credited you guys as saying that you actually know what you're doing, because you do. But outside of your group, your competitors, would you agree there's a big chunk out there that are raising money and are clueless? Starting with you, Ken.
Yeah, I would say I would bifurcate between operators and financiers. And there's half of them are financiers, right? I came from that world. Everything looks great on a spreadsheet. But when you actually need to implement and operate, that's where the rubber meets the road. And so I do agree. I mean, there's other buyers that will move up into that operator, like successful operator tier. There's no question about it, right? They have the right backgrounds and focus, but yeah, I mean, a lot of them haven't even actually raised the capital that they've said they've raised. So.
Yeah. Okay. Just quickly before we move on, Nate, do you want to give a quick introduction to yourself and we'll move along? We're on the first question, which I'll brief you on in a moment. But if you give the audience a bit of an introduction and we'll get started.
Sorry to be late. Hey guys, I'm Nate Jackson. I'm the VP of Acquisitions at Perch. So nice to be with folks who have the same job as me. I'm sure we could have a beer at Prosper to catch up and trade notes on the craziest year of our collective lives.
Cool.
But yeah, been with Perch since last February and excited to be here chatting with you all.
Sounds good. So Nate, the first question that we come to, which Ken kindly started answering just as you was joining, is the majority of Amazon aggregators aren't operators and don't get it. So to rephrase what I was backing up on last week, I just said at least the top 10% know exactly what we're doing in terms of this discussion, but I don't know fully about the 90%. And if there is actually 100 aggregators in the space, but the point is, as a leading aggregator, do you agree that we are in a space where there are aggregators out there that are clueless? They're good at raising money, but they've got no technical chops or good at operations.
It's a good question. I would say my first observation is, like, if the assertion is this is hard, like being an Amazon operator is hard, like fully agree. I think everybody on the call obviously knows that. And what I would say is I would much rather be on the other side of, our 70th or 75th acquisition versus one of our first 5. We learned a lot in those early days, and I think I'm glad that we were doing our first 5 deals over the span of 5 or 6 months, so that we could absorb in some of that learnings. Kind of going at the pace that I think I see other people going today. Certainly would be a little bit more scary to buy a larger, more complex business when your team sort of hasn't fully gelled and isn't as deep on all of the 27 aspects of running one of these businesses. Never mind, a large number of them. So I don't mean to venture what everyone knows or doesn't know, but I can agree with the sentiment that running one Amazon business is really hard. It's a dogfight every day. There's 30 things you got to do really well to sort of compete well. And so when you're trying to do that across a bunch of businesses that, where you don't have the advantage that a seller has of having lived, slept, and breathed baby blankets, baby swaddle blankets, whatever it is, that there's an extra bar on everything else that you're doing to do that. That's kind of my initial reaction to it.
Okay, cool. Rob, I'm sure you've got some words to say about this.
Yeah, look. I think the first observation is, it's a nascent business model, so we're still in kind of the first innings here. So I think, of course, there's a lot of new players to the space, and there's some older, more mature ones. Now, when we talk about the older players, it's those who've been around kind of more than 12 months. So, and I think Nate touched on a valid point. We bought our first Amazon business at the end of 2019, and everything that could go wrong with that acquisition did go wrong. Our rank tanked. The account got shut down for a period of time. So we managed to turn that around, and I think we took a lot of those learnings and kept building on that. Every deal we did kind of stepped up in size, but we went really slowly. So I think we learn a lot over that point, and it's enabled us now to kind of move with kind of a slightly faster pace. But I think it's very complex. The one thing which has surprised me, I kind of came into this industry in about August last year, is just, it's a lot more complex than people think. People think it's kind of like a digital asset class and it's easy to bolt these things in and scale quickly. But, when it is a fight every day, and you do have to have experience in the team to operate them. So certainly, some of the new players will figure it out and some won't. I think one observation is, multiples have increased. So, your margin for error is much, much less. If you buy a bunch of bad assets and pay up for them, it's not going to turn out well on the other side. So,
yeah. Brandon, what's your take?
I tend to agree with what everyone's saying here. We've been at this for almost 3 years now, and I can say we've learned a lot over those 3 years, made a bunch of mistakes, and it takes a long time to build that confidence in how to run these businesses. And how do you run advertising? What do you do when an account gets shut down? How do you assess black hat tactics? How does supply chain work? How do you inbound, with all the restrictions? And Amazon's not getting easier; it's getting harder, or at least more complicated. And to sort of have that under your belt says a lot for some of the folks in the space. And I can't assess how strong everyone is or isn't, but it is a complex ecosystem that we operate in.
Yeah. The other standout, there's a few standout questions, but this is the second one. Again, this is some of the notes that Rob sent over. We just made some valid points. You can't get a fully optimized outcome by selling your business directly to an aggregator versus a broker-led process. Rob, do you want to take this one first?
Yeah, thanks, Danny. Look, I think there's always, it's a question which is getting raised a lot, right? Because there is a big broking community. Brokers are our partners in this business as well. We bought a lot of businesses from brokers over the last, 12 to 18 months. I think there are pros and cons in dealing directly, and there's also pros and cons in dealing with a broker. I think in terms of what I'd say in terms of dealing directly is, you get speed, and you get kind of certainty of completion. I think, one thing we would say is, the space has got more competitive. I think if you wind back the clock in the early days, you could speak to a seller and be the only party kind of in that kind of room. But I think now there's always going to be multiple people. So we never underbid an asset when someone comes to us, because the moment you start underbidding an asset that you like, someone else will take it. So whether someone comes inbound to our website or it's a broker-led process, we'll always be bidding at the top of our buy box or where we think the value of that asset sits, because if we think something is a strong asset, you want to own it. You don't want to lose that process. So from like a price and value perspective, we certainly don't bid any differently, whether it's a broker-led process or something bilateral. So that's something to just keep in mind in terms of how we approach our strategy.
Yeah, I mean, if you look at that process, is that person effectively comes in to look after the seller to work with, say, an aggregator, but still the person who comes into the process is getting paid to do a job. So they're serving themselves in some way as well because they get paid. So there's always going to be a level of biases. But I do understand partly on that question. Let's be honest, most Amazon sellers are first timers, right? They have never sold a business before. So they should be thinking about at least having discussions. If you've never done something before, Rob, for instance, you never done anything before, you'd get advice on it, wouldn't you? And so I think there's a role playing there, but I think the bit that you're coming round to is that you can have so many people in the mix that stuff doesn't get closed and it gets dragged on for ages. And I know a lot of you guys work to optimizing a really good, complete process. So it's as pain-free as possible, but some of these guys can put a spoke in, would you say? Rob?
Yeah, look, yeah, definitely. I think if people haven't done it before, having an advisor there can be helpful. What I would say is that the earlier people start planning for the exit, the better. So if they're thinking about an exit in kind of 6 to 12 months time, start having the conversation with people like ourselves today. And go contact 10 of them, a really successful seller we know, he contacted 25 aggregators. He ran his own process. He got offers from around 6 and chose us in the end. So and he got a great outcome, and he ran and, he had confidence he could execute it himself.
Okay, cool. Ken, what's your take on it? You've done a lot of deals recently.
Yeah. We've done deals with all the brokers and advisors that are out there and have seen a lot come to market. So I actually think there's stratification among the broker and advisor community as well. There's there's probably a handful that I know when I see a deal, it's like, no one else wanted to touch it. And it's like, it's like a pre-qualifier for us almost.
Yeah.
So I think there's always going to be value in getting as many people as you can to the table, right? I liken it to selling your house. Like we just did a transaction last year at private market, right? But because we thought we were getting the right value, and we didn't want to get our 4 kids out of the house every Saturday and Sunday for a month and figure out what the hell to do on Thursday night, from 5 to 7 for open houses, right? We had a price in mind, and somebody came in and gave it to us, and we didn't come along with all the hassle of testing the market, like in an open process. Now, for some people, they're like, hey, that's my best way to maximize value. And that might be. I mean, there's no right or wrong answer to this. I would say that the one, I think, con of going to is it feels transactional, right? These are we like to create win-win situations. We like to have real conversations with entrepreneurs and owners and say, hey, what do you want out of this, right? If it's, hey, I just want the highest number and I don't care about anything else, great. Then you should go to a broker and then get in a bidding war. And if you don't even want to manage the process and you're just like, hey, tell me. But there's some advisors that don't even let you talk to the sellers until you submit a term sheet. It's like, well, we don't even know what they want out of this. What's important.
Sorry, can you break the dynamics of that process down for the audience so they understand? You're just saying that
they won't touch it until. There's some advisors that say, they run a process and they're like, hey, you gotta submit an interest of intent, and you just get watered down financials. You don't get to talk to the sellers, and so you're just going on numbers, right? You don't know hey, what's their growth opportunities? How are they thinking about the business? What products? Give a narrative around the earnings. We're out of stock and we got attacked, whatever it may be. It's just very sterile.
So is it a little bit of smoke and mirrors as well to prop it up? Is that what you're saying? Or
and then you just don't know.
Get the highlights.
Not smoke and mirrors, but right. And then there's deals where, to be candid, someone's like, hey, you got to be an advisor's and they're playing a game too. And sometimes advisors get burned, right? So the sellers, might not know that the game the advisor is playing, and they're just trying to get it. You might be one of two offers, and they say, hey, we got multiple offers, and this is where you need to be. And we've walked in those situations. They come back to us and be like, all right, well, they'll take that original. We're like, well, then you didn't have someone else on the table, or they weren't bona fide, right? And so you do run the risk if they're not in the market, they don't know all the buyers too, right? That they might push them to the wrong buyer. Right? The buyers that don't have the capital, that don't know how to close, that don't know how to transact in this marketplace.
Yeah, Nate, what's your take?
Yeah, I would echo some of what Ken just said. I think the most, so similarly to these guys, we've done deals with virtually every advisor and broker out there. We've done a lot of deals directly as well. And I think one of the things that I've found most challenging in the past several months, and I think it's challenging for us, it's also challenging for sellers, is exactly what you're describing, Ken, where I think part of it is now in a brokered process, there are 20 conversations that a seller might have to have, and it probably all blurs together for them, and you get into these situations where you have to submit an indication of interest before you've met the seller and had all those insights that you've talked about. And I frankly think those situations is where there's a loss of sort of opportunity. And I think I've probably never written the exact same structure of a deal that we've signed out of 70 deals. Largely because it all comes from like what Ken was saying, which is, what are you looking for? What is the exact opportunity that you have? Where are the risk points that you're actually nervous about and that we can sort of structure around? And where are the big opportunities that you can structure around? And that's just hard when you're kind of railroading in one of 20, 30-minute conversations. And so I think frankly, Rob, you talked about somebody who went and talked to 25 people and got 6 offers and came to an outcome. I think probably if you're a seller and you want to go direct and you got the 3 of us and 1 or 2 other people on the phone, you could probably, if you're willing to negotiate for yourself and sort of run a process, you could probably get to a similar outcome without talking to 30 people. Unless there's something unique about your business, right, that makes one person out there the absolute best acquirer that has outsized value for you. I think if there's something about your business that where you think that is the case, that's where a thoughtful intermediary makes a ton of sense. In particular, I'm trying to think about basically if there's some strategic out there that is going to pay you some multiple of revenue that just won't make that doesn't make sense in our models, even though we aspire to double these brands and so on and so forth. If there's some other sort of buyer out there, but I think frankly that's probably the exception rather than the rule that would sort of require going off and soliciting something like that. But yeah, my main takeaway would be for a seller, like somebody that's out there, don't hesitate to have early conversations. Talk to a handful of people that are serious, that have a track record of doing what they say they're going to do, and see where you get with the offers that you're seeking, and also talk to brokers. Right? It's not like there's no reason that you can't explore a bunch of that before you decide on a path.
Yeah,
and I would just say I was commenting to my team yesterday that I'm actually seeing less and less lead deal flow from the broker advisory network as a proportion of overall deals that are being transacted in the marketplace. So if everybody thought that was the best route, I think you'd see Monday morning, you'd come in and you'd have 10 deals from every broker, and that's just not the reality of the market right now.
Yeah, I mean, from an observation point of view, I would agree. But I think there's been a rise in terms of education about aggregators and podcasts like this one and other people's podcasts. And you guys, most of you are out and speaking at events and sponsoring and stuff. I think part of the change is it's become part of the new norm as a format as well, because originally people would go to brokers like a website brokers, etc., to sell their business. Yep. Now there seems to be a thing which is the aggregator space, because it's created its own ecosystem, if you like. So I can see why there's a lot of deal flow heading towards aggregators because of the visibility as well. Brandon, do you have any comments on this?
No, I mean, what everyone said makes a lot of sense. I mean, there's no right or wrong answer. at the end of the day. And some of it comes down to if it's strategic or not. Like if you want to get into a retailer or a specific retailer, maybe you go to someone who's got inroads in a certain segment of the market or something like that. But as all of us here, we talk to more sellers and we learn more about the ecosystem, and I'm learning something every day. Like we're talking to Danny or Liron or Brandon Young, like whoever it is, like there's this ecosystem of learning and sharing that we just all have. And part of what you get from going to someone like a Thras or others is like there's the most, Ken's on the front side more than I am, but the most exciting part for me is when I get to talk to the sellers and I get to figure out what do they want with their brands. Like they always dreamt of a massive D2C business, or what are the products they want to launch, or where do they want to work with celebrities? Like where does this thing go? I think that's what gets super exciting from probably from all of our angles, is how can we build these brands into something amazing and much more than, when it hits our hands.
Yeah. So another question on the list, there's a lot of fast money and the market is a bubble. So effectively he was saying that, there's a rush of cash coming and this will be another 12, 14 months, he predicts. And then suddenly when a lot of these aggregators have raised money, there's going to be like a sink and swim situation because the returns may not be there, or they're paying too much because they haven't done deals because they can't catch your tailcoats as leading aggregators. Do you see what I mean? So he thinks there's a bit of a bubble in the market. What would you say to that, starting with Rob?
Yeah, look, I don't think it's a bubble. I think you're at day one of kind of an evolution of a market. There's a highly fragmented industry which is becoming more institutionalized. And if we look at the proportion of capital raised to the size of the market, it's still very, very small. Let's just call it, I think the last number was, probably more than 4 billion now of capital raised to acquire Amazon FBA businesses against the market, which is 300 billion. That's a $300 billion market is bigger than the GDP of South Africa. So if I told you that there was $4 billion raised to go buy real estate in South Africa, you'd probably say, well, that sounds pretty low, right? So I still think, I don't think it's a bubble. I think there's obviously a lot of new players coming in. Is that money hot? No, I think that money's following a trend. I think there will be players who get it wrong. They'll buy the wrong assets. They'll move too quickly. They won't understand the operating complexity. But I still think, the bigger, more successful players and people who get it right will be able to keep raising capital, and they will pull ahead, and there'll be a bunch of very large players at the end of this. I don't think it's a winner takes all market, and there'll be a bunch of people who kind of grow nice sized businesses, and there'll be a bunch of people who don't quite make it. And there's already been a few over the last 18 months that's happened too. But that's always life in kind of a capital market. There's hedge funds which blow up every week. So that'll just be a natural evolution of the market. I think, I don't think it's a bubble. Like, I think multiples have gone up, but I think that reflects just the amount of capital that's coming in a very short space of time. But fundamentally, it's still a lot more sellers.
That's part of the first point. Fast money has come in, but the point you're refuting is the bubble, because it's the 300 billion market and there's only 4 billion raised against that 300 billion. So there effectively, it can't really be a bubble.
Well, yeah,
because it doesn't exceed the value of the market.
It's an evolution. But I think, if you fundamentally look at the number of sellers versus the number of acquirers, like, it's significantly skewed on the supply side. So I think if multiples keep increasing, you're going to see more and more people coming and listing their businesses for sale. So,
Ken, you're up next. What do you think?
Yeah, I mean, the fast money, it just makes me laugh. It's like we're buying these assets and running them for with no plans of flipping them. We're not trading. I do think, to echo Rob, right? I mean, look, when we got started, we were one of maybe 2, 3 out there, and we were paying 2.5 times EBITDA, or trailing 12 months profit, and but we weren't getting tons of looks at businesses, and we were kind of market takers, and whoever raised their hand, we had to take a real look at, and that's changed dramatically. We're now self-selecting which is a great position to be in from an acquirer standpoint. I think there's a natural level, and this is, we talk about this internally, even from day one. Like we need to move off of, transition from a financial buyer to a strategic buyer, and we're there. And I think the businesses and the other aggregator operators that cross that chasm are the ones that are going to stick around. And then there's going to be a natural, right? Like everyone's going to have their own hurdle rates based on their cost of capital, et cetera, on what they're willing to pay for an asset. Right. And it's just like any other marketplace, like value is in the eye of the beholder. And right. So do I see a point in time where Amazon businesses trade at 10x? Probably not. There's still risks inherent in the asset, right? As an asset class. So there's probably a natural overall ceiling of where valuations will trade. I feel like we're probably, 12 months from there, personally. But I don't see it as a bubble. I think it's a gold rush. I think, quite candidly, I think we paved the way because a lot of our early investors were saying, hey, there's massive Amazon marketplace risk. Like we raised debt early on because of that, right? And we've kind of shown that, hey, you can ring fence that risk and you can execute well within that risk. And that's really, I think, the valuation. It looks like, they've doubled, the upfront's doubled, but that's because the risk profile has decreased, right? And so I think a lot more people are getting comfortable with the concept of buying an Amazon business, and that, it's not going to go away tomorrow. I mean, but you see that you need to do your diligence and buy the right businesses because that's still a risk, which will, I think, ultimately always keep some kind of risk reward cap on valuations.
Yes, indeed. Nate.
Yeah. So the way I would frame it is, I'd agree. It's hard to. I'm not an economist. I find it difficult to define what a bubble is. The market has certainly changed a lot in the past year. I think in good ways for both sellers and buyers. Certainly for sellers. A year ago, I never had to do an IRR calculation when you're like early days when the trading multiples in cash at close were 2 to 2.5. There's just really it was mostly like, what is the market clearing price for this business? Whereas now, the market clearing price is one where we really have to think about, hey, what are the 5 things we're going to go do to grow this business? What kind of growth can we underwrite? And there are places where that growth is higher. There are places where that growth is more moderate. This past year has been super complicated with what happened last April, May, June. And how do I think about normalizing for that? And so it's certainly been a dynamic time in terms of pricing and a dynamic time in terms of underlying trends in the businesses that we're acquiring. And I agree with Ken that we'll learn a lot in the next year as the world goes a bit back to normal. Buying trends go less completely haywire in individual categories, and most importantly, as the large number of people that raised a large amount of capital get to have more of a long-term scoreboard on how they're doing once they've acquired these things, because that's really, I think, the ability to raise and re-raise capital is where I think you'll see a winnowing a bit, where some folks will justify, some folks will continue to have access to capital, and frankly, if you bought brands that you shouldn't buy and you don't run them very well, I don't know how to think about the way that every investor will pursue sort of continued investment in something that they've put money behind. But I expect that there will be some normalization, some rationalization of the capital that is coming into the market, and the people that will continue to raise will be people that can drive value. But the more that people that can drive value know that, the more they're willing to pay as well. And so I think the thing to recognize in terms of multiples for these businesses versus a more conventional sectors. I worked with private equity investors before, where the multiple at Bain, where the multiples are just dramatically different. The difference here is that each of us has to layer in G&A, like general administrative, on top of the earnings that we're generating. So yes, we want to grow the businesses, but also we've got things that sellers we're buying a business from aren't doing. We've got our M&A functions. We've got to pay for Ken's new house and my sleeping bag, and there's G&A that exists in our business that we're adding on top of. And so even when you talk about getting 3.5, 4x multiple today, depending on how much of an aggregator's business or revenue goes to headcount costs, that actually starts to look a lot more like a normal market multiple, and especially when you layer in the risk profile that underlies some of these businesses, or all of these businesses. I think we're pretty close to what is a fair and market clearing price, just kind of a more balanced market. And I think the good thing for all of us in the sort of prices going up, one, great for sellers, and two, as Ken was saying, there's just a bunch more interest in people saying, yes, I want to sell my business now. It's good for us. It's paradoxically good for us to be paying more, because people are like, heck yeah, I'll sell my business for $10 million. Where if it was much less than that a year ago for the same business, I think it makes my job easier, frankly.
So can I ask a question just to bounce off the thing with regards to people good at raising money? It's not going to impact you guys because you've got a lot of deal flow, but what does it look like on the inside? Someone goes out, an aggregator goes raise money, but can't get a sniff at the table. Everyone else hoovers up the businesses. This aggregator just cannot spend their money. They're upping up the multiples, but no interest in building, like working with them. What happens to that fund, and what happens to that aggregator when they don't meet their requirements after the initial raises, 1 or 2 rounds?
I mean, it depends on their source of capital, right? Like if they've actually raised equity, if they raised debt. In a debt instance, right, they would kind of just pay it down with the interest, depending on how high that is. Can be onerous, or they go into self-preservation mode and they buy some assets, and like the aggregators are going to get aggregated at some point, right? Like some of these guys, like it's just,
so they get eaten up.
Yeah, I mean, you've already seen it, like 101 Commerce assets went to Goja, right? Like, I mean, they were early days, so there's always going to be buyers of Amazon businesses, and particularly if you just do a round of funding, like you're probably not. Let's just say you raise 50 million, right? And you go out by 10 to 15 million dollars worth of EBITDA, right? And it's like you're probably not doing much integration on the back end. So if those, they're all kind of still being run independently, so to speak, like someone else could come in and buy those off of you, like buy those up.
Okay, so it's not really a drastic situation. It's more of embarrassment. Sorry, guys, we've raised this fund, but we can't get a sniff at the table because the top boys are taking all the deal flow. So it's not like a big issue, but obviously there has to be a proportion of the market that win and a mass proportion that don't, like with anything like the 80-20 rule. How many I don't know exactly. Well, we're looking about 60 to 80 aggregators in the space at the moment, or is that a bit too many? I know there's at least a top 20. What would you say on the table?
I stopped counting at 40 or something. So right, it's more than 40.
So it's more than 40. What do you, in your opinion, think out of the 40, how many of those do you reckon are going to win and others fall by the wayside? I'm not asking to name names, but what do you think is realistic? Although the pie is quite large, and people will get more sophisticated over time by watching the steps of what you guys are doing. But out of the 40, are we looking at the top 10 really are going to take it all and the rest are going to be feasting on what's left over?
Probably, yeah. I mean, it depends, right? I would say, 10 to 15. If I was starting one today, I'd specialize in a category or a niche where you can really start to drive outside returns off of Amazon. Right, like health and beauty or something like that, where you're investing in other assets or modalities of growth that are germane to that niche, right? Like influencers or just things like that. I mean, that's what I would be. What we're doing, right, is kind of category agnostic. That's going to be a tough game for I think a lot of people that are just starting now. And we're even seeing it in, like, Brandon, go ahead. Sorry.
Yeah, I was gonna say I agree with Ken. Like, I think if you're just getting into this now, specializing is key, because to do this the wide approach is challenging, and to bridge that gap is going to be difficult. I think what might happen to a lot of the newer entrants is you're going to get stuck with a lot of deals that are just not good. Also, like the black hat, the stuff that you can assess that you'll hit a wall, and if you're sort of desperate to join the bandwagon to buy these businesses because it's you've got the money, you want to deploy it, and you're deploying it inefficiently in businesses that are actually not going to scale or not going to last, you're going to get into trouble. Where if you specialize, you can at least weed out, focus on what you know. And if it's beauty or if it's wellness or it's fitness or whatever it is, like, this category, you know it well. It's one way to hedge against those businesses that haven't made it up to the top yet.
Rob, you got anything to add here?
Yeah, look, I think it's difficult to put numbers around it, but I think there will just be, it's just natural selection, right? There are going to be better performers. There's going to be better performers. So think of it, there'll be the top 20%. So, maybe by the end of this year, there'll be 100 people in the space. There'll be 20 bigger ones. Also, there is a first mover advantage here because those that started earlier have that track record, have that experience, can raise more capital, have more experienced teams. So that kind of feeds into that kind of way that the market will evolve. And I think, Ken and Brandon touching on the newer players coming to the space, from what we can see, in my perspective is, multiples have increased significantly. So before, when you're buying assets at 2.5, 3 times, you could just, if you thought it was a decent asset with a bit of growth, you could kind of just execute on and move forward. But now, you have to really look at that. And Nate touched on that and really think about, is this an asset we can grow? And if anything doesn't quite smell right, we're pulling out straight away. But I think people who have capital to deploy and do want to kind of build a business, might be doing deals and looking past things, but the margin for error is far greater now. So we've definitely been very selective in the last few months. So yeah, we'll see.
Yeah. All right. Final question from the notes you put down, Rob. Aggregators don't have a strategy or thesis, which from my memory, and it maybe serves me wrong, it wasn't just more so that they don't have one, is that there are people that are trading with no background and they're trading effectively on theory. But what's your take on it, Rob, as you kind of pulled up that question, and then we'll move it over to Nate and then Ken. Yeah,
look, I think there's a lot of people out there that buy and build Amazon businesses. So that seems to be the thesis. I think we started on the platform in 2016. So I think we understand the complexities of the business. I think, where we're getting to is that, we're building a global CPG platform and a tech platform that's going to support that. So we're investing, we're starting to think about and investing in that side of the business a lot more aggressively. But I think, just buying a bunch of businesses and aggregating them and thinking that creates value on the other side isn't necessarily true, kind of for all those reasons we've just discussed. And the fact that the market's getting more competitive and multiples are going up, people do need a strategy, and new players do need to be focused. That kind of category agnostic aggregation strategy is going to be a lot more difficult going forward.
Cool. Ken, what's your take? Aggregators don't have a thesis or a strategy.
I think everybody's different. So I think the ones that are financier led probably don't, outside of multiple arbitrage. I mean, I've already had people reach out to me saying, "Hey, I have 10 term sheets. They haven't even transacted, right? And do you want to buy this portfolio at X multiple?" Right. So I think there's going to be a lot of people that are entering that are looking at us and Elevate and Perch and saying, "All right, these guys are going to start buying, aggregators, smaller ones, and they're just playing. If they can go out and if they have a thesis that multiples are going to continue to rise to 6, 7x, and they can acquire a bunch of assets at 4 and play that multiple arbitrage game. I think there's people that's their thesis, to be honest. We'll see if that plays out. I think ours, right, is from day one has been, let's buy high quality products at good prices, and we're using Amazon FBA as our R&D and product R&D engine. It's accretive assets that we know we can grow, Some of them are just great Amazon products, right? And that's a great thesis. Some of them are brands that we think have real breakout potential to become household names. And so we have an overall operational thesis as a company, but then each acquisition has its own thesis, right? And you have to figure out as an acquirer where that thesis plugs into the broader operational, and make sure that everybody's aligned when it comes into the company as to what the real acquisition thesis is.
Yeah. Nate, your short take.
Yeah, I think a broad statement. If all 100, if we named it, players have no thesis or no strategy, I'm sure everyone.
I think that was Rob's interpretation of it, which I agree with. But I also think if we put a bit of context to it, I think he was saying is that not necessarily you guys at the top of the tree, but other guys, they're trading off a thesis, but they don't have any history. Therefore, it's just theory. So I think that was part of the context of it as well.
Okay, got it.
Yeah.
So this is slightly different. But yeah, I think, one of the points I think agree with the various aspects. So some of what Ken touched on, which is each deal needs its own thesis. So there might be deals that we buy where we actually don't, we're never going to take this product and run a bunch of influencer campaigns on our disposable plastic plates because it's a disposable plastic plate, and who's going to be an influencer for that? Where there might be products where there's not a huge growth potential for that underlying market for whatever reason, and there are other ones where we think that it can become a household name, as Ken's saying as well. So I think it's right that our view and my view is that each deal needs its own has its own basis on what we believe we can go do that needs to be aligned to our capabilities. And so one of the reasons that you see rapid hiring, Ken, I saw you guys on your LinkedIn posts onboarded 100 people this week, right? One of the reasons that we're all hiring and expanding our team so aggressively is that the core to any of our strategies or thesis is capability building and aligning. Like the more capabilities we have, the more opportunity we have to have a great thesis for a given brand that we're acquiring, right? And so we're pushing pretty aggressively into brick and mortar. It will be no surprise, and that usually comes from making an acquisition where we say, okay, we've got a couple $1 million of sales into Target now. Let's go figure that out and figure out how we can push more through that. I think all of our learning has come from acquiring a capability and then deciding to invest strategically behind that and find the best talent that we can to go pursue it. And I think the other thing that probably needs to be true to what I think this stitches together some of the conversation earlier around, what does the end state look like? What are the top 10, 15, 20 that persist? I think for any of us, managing the massive volumes of complexity that come with this is critical. And for us from day one, the answer has been that we need to be investing way more than we think we need to in our tech to get ahead of the troves of data that we'll have and the troves of the huge volume of work that needs to happen, and not just scaling linearly with each brand that we buy, but really building capability improvement from the start. And that's where I think a lot of the interesting market dynamics haven't fully thought through are, but 100 people can't and shouldn't be building and investing in this new software platform that didn't exactly exist 18 months ago, right? It would be kind of a waste if all of us hired an amazing CTO and built out an amazing engineering team to build essentially the same, a similar software platform. And at the same time, I think there's nobody out there that's actually building exactly what any of us need, and they won't because it's going to be so customized. And so I do think that is going to be a critical thing that, people get 12 months down the road and they'll say I need 75 engineers to build and maintain the system and processes that we need to sort of get this thing to the scale where it needs to be. And that will be kind of a reckoning or a judgment call for their investors of, is that the wall that we need to plow through, or are there other exit options that we have versus trying to climb that hill if they haven't already? Because there's a bunch there, and it's, I think, critical to being able to do what we're all trying to do.
Yeah, and 75 engineers. One, it's going to be tough to get 75 good ones, and the cost of those to prize them away from where they actually are at the moment is an absolute fortune. So I can imagine that's going to be tricky. Last question. This one's actually from me, which is not on the list that Rob sent over, but what I found interesting was when he was saying is that when he'll line up deals not just with aggregators, but everyone. He was talking about families and stuff. And my pushback on it was, well, you're saying that maybe aggregators know the value, or I say undervalue the asset as they're going in, but these private families will pay more. And my thought, and someone else I spoke to about this as well, was if you don't know anything about the asset and you've got no chops in that area, why would you value it higher than someone who knows about the asset? Does that make sense? So it's kind of trying to say that these
because
people
it's a bubble,
here,
Danny.
it's a bubble, yeah. So what is your take on that? When someone has no idea about an asset, but they want to buy it because they hear that it's trendy now to buy e-commerce businesses? Yeah.
Yeah. The only look, I mean, I came from that world, family offices. Like they would only do that if the owner operator is going to stay on, right? And then maybe they use that to go and buy, right, like as a linchpin, and to go buy more Amazon businesses and build a team around it, right? And then in those instances, the seller is going to they're going to do what's called roll equity, and they're going to maintain 20% ownership of that, and they're going to be, to build on the team, et cetera, and hopefully get another bite on the apple down the line. But the family office is going to buy an Amazon business and take it on and run it. That's not their playbook. It's more an investment, a passive investment strategy. So they're going to most likely keep the owner operator involved in running the business day to day.
Yeah. Okay. That makes sense to me, because it wasn't calculated. As I kept pushing back on that same question, it was like, but where's the operational chops coming from to do this, and why would they value the asset like that?
Yeah.
Rob, what's your take?
Yeah, I think Ken touches it, hits it right on the head there. I think, there are financial buyers of asset, whether they're PE or family offices, but, it's still a complex operating business. So they either have to have their own team to run it, and if they don't have their own team, then they expect the seller to sell on. Now, a lot of the sellers we speak to who are selling their businesses are interested in cashing out and moving on. They want to either start another entrepreneurial venture, retire, take some time off. So that model doesn't necessarily work for everyone. So I think it's a case-by-case basis. That doesn't mean you can't sell your asset at a good price to a financial buyer, but it might come with kind of other strings attached, that doesn't meet the seller's objectives. Everyone we meet has different objectives around why they want to sell, what they're solving for. So it really does kind of go case by case. But I think as the market develops, as it becomes more complex, as multiples increase, then, the people who can assess the growth, which is what Nate touched on before, are those who are going to pay high numbers for the assets and buy with greater confidence. And I think those people will be the people sitting in this room here. So
cool. Nate, what's your take?
Yeah, same thing. We've encountered this a number of times, and generally speaking, it's just a totally different proposition. It's like, do you want to sell your business and move on? There will be some transition, or do you want to keep doing this with growth equity behind you? Basically, you're not exactly selling your business. You're maintaining your job, your exact role. Probably gonna have to hire, I've had people that have been told, we want you to hire a CFO and this, that, or the other thing. So there are going to be other things that are layered on. Most of the people that are selling their businesses are selling it because they're saying, I don't want to grow a huge team. I don't this is hard, and it's been 100% of me nonstop for 4 years. And I can't imagine doing that for another 4 years. And no offense to private equity folks, but I don't want to work for a private equity fund who's going to ask me about why my margin dipped by 3 bips in May. And so it's like a really different dynamic. And there are people who are ready to do that and want to, be a part of growing their brand to its fullest potential and have the energy to sort of do that and roll equity. But the majority of folks that I'm talking to are in a spot where, they'd prefer to exit and have a share in the upside as we do continue to grow it. But really, it's just kind of apples and oranges in terms of what that looks like for the seller. And I think one of the things Ken said is true, that even when you think about who they're going to sell to 3 or 4 years down the road, that new buyer will probably also want you to stay. Like, will probably also want somebody to be in place to run it. And so you really have to think about what is this family office's end game. And unless they're selling to somebody who can self-operate or bring in an executive to fully replace you, there's not a super clean and clear and easy exit path. And I have to drop. I don't know if you guys are rolling on, but
yeah, I was going to move. I was going to say I'm going to move to the comments. I'll say goodbye to you now because I know you have to dip. I'll go to the comments and then I'll get final thoughts from the gentleman here. But thanks for joining us, Nate.
Thanks, guys. Nice to meet you.
Right.
See you, Nate.
Okay, comment. So Miro, I appreciate the fact that Ken understands there's a lot of complexity here. It goes on to say we're an Amazon, Shopify, Walmart warehouses, and not just channels. Each of those are separate businesses. He's commented here again. A lot of people don't have the skills or patience to recruit and run a large team. I think it'd be hard to transition from a solo entrepreneur to a team member. Yes, that makes sense to me as well. I've had experience, even like from the music industry onwards. I never want to go on to that next step with the larger company. I've always stayed independent of that because you retain not your integrity, but your creative control and stuff like that. So it can be quite difficult as a founder and very focused on what you're doing to go and join someone else's team and then effectively work for someone else. Let's have a look here. Joe says, this is great info for sellers, great panel, Danny. And then Joe always writes a beautiful essay for us. So let me just go through some of these. Sorry to cover your faces, boys. My only experience in the past is that investing in Amazon-only business for non-Amazon sellers is not favorable. Several of the bigger investors have been burned badly by purchasing Amazon businesses from black hatters. They won't move on an in-com business without the main list and off Amazon sales channels and network because of the risk involved with Amazon itself. Owned assets like email lists and additional sales channels grow a multiplier easily because it spreads out the liability. I'm going to have to come over to this part here because it's run off the screen. Sorry, Joe, that's going to run off the screen unless you've got more to be added here. Let's just jump to Brandon's comment. Hiring and scaling are by far the hardest part of business. Where you run an 8-figure business, so you'll know. Large buyers with mature and sophisticated management companies are positioned with huge advantage. Again, technology, it's a numbers game. If you've got a great team, I've got Ellis at Databrill, irreplaceable for me, and Brandon, you've seen him at work, and I think Ken has as well. He's a cut above.
He's amazing. So, yeah, I mean, Databrill is one of the best out there.
Yeah. So, well, that's for you to say, not for me to say, but for me, like working with, there's only so many Ellises that will walk in your life. And that's what I was talking about earlier on with Nate. Getting great engineers is tough. We've had a high churn of engineers who there's a difference between being 10 times better and 100 times better. Like an engineer, you can put them on the same amount of money, but one's output and skill set is far superior to the other. It can really, really be dynamic, the change there. What else have we got here? Dick says, thinking of setting up an EMS account in a low tax jurisdiction, Isle of Man, Cyprus, Hong Kong. What are the implications for exiting less attractive to buyers? Ken?
Yeah, actually, we're mostly agnostic to where you're domiciled because all the transactions are asset purchases. So we're kind of buying the assets out of the entity. So there's certain tax beneficial jurisdictions such as the UK, Germany, Australia, where share purchases make sense because of the favorable tax savings to the sellers. But yeah, we bought businesses from Isle of Man and Hong Kong. So not yet Cyprus, but I'm sure at some point we will.
Cool. Rob, do you got a comment to follow on that?
No, I think that's
He's
right.
covered.
Yeah, most people do asset deals anyway. So
okay. So Paulina, I'm getting a final offer for my 18th brand on Friday. This is very timely and I'm sure extremely valuable info. Thank you.
Paulina, call me.
Yeah.
That's
okay,
great. Congratulations.
So,
hopefully.
Congratulations. Yes, indeed. Hopefully it's not one of your deals on the table now it's been exposed. Right, it's horses for courses, aggregators versus MA brokers. It depends on the channel and mix. I think that's pretty much here on the comments. Co-host Sharon says, when working with a broker, in my experience, they've helped to fix things so that you can sell at a much higher price within 6 months, just her experience. Any final comments from you guys, advice to sellers out there at the moment, what the market's looking like? What's the top 3 to 4 things or top 3 things you would suggest to get ready for sale? Start with you, Brendan.
I mean, I can take it more from the marketing advertising side of the house, but I mean, one of the things we see when brands come in is sometimes they're just not being as aggressive as they can be, whether it's with advertising or using influencers or outside traffic. So, I mean, a lot of sellers are hesitant to try some of the new things out there, but I mean, I would say don't be afraid to try to see what you can do for the business, because Amazon's always shifting. Even if you just look at, a couple Saturdays ago when we had that massive breakage and Amazon was just very chaotic that weekend, and we've come out of it better position. But advertising seems like it's taken a new front and center on Amazon. At least they're trying new things. And so always be experimenting when it comes to different forms of advertising.
Cool. Some people spend too much time trying to diversify and slows their growth. Spending more time on one channel has the best return on investment. I totally agree. I used to bump around all the time, and with my clients, I just say, look, if you're in the US, stick to the US, keep launching products there. Don't spread out unless you've got a ubiquitous product. I'm not saying sell umbrellas, but an umbrella is a ubiquitous product. So you're going to have to search volume in Germany. You're going to have to search volume in the UK, but obviously don't sell fucking umbrellas. Worst thing in the world. But that's a ubiquitous product, something that translates, not like taco holders that has no search term value in the UK or Germany. Miro's back again asking a question. How do you guys value supplement brands?
Yeah, look, I'm happy to take that. So at the moment, we're not buying supplements brands. So it's something to think about. So we just see high levels of compliance risk, which we don't fully understand yet. So.
Well, that's a good question to ask to finish on, if you don't mind saying. What, and Ken as well, and Brandon, what kind of brands do you avoid? What categories do you avoid? Because that's going to be key for people to understand as well. Where you're looking. I know that it's a different asset class to everyone else's. They have different decision making. But Rob's just said supplements.
So we're similar. We haven't. We're like 6 months ago, or maybe 9 months ago, we're like, oh, we should dabble. Let's dabble. And, we signed 2 term sheets. We get products independently tested, and they were completely false, like 0% of ingredient concentration that's claimed on the label. So we're like, all right, well, that confirmed our thesis. Let's sideline supplements, amongst other reasons. So supplements, I would say like fast tech, right? Like Bluetooth headphones, things like that. Like China has 2-month product iteration cycles. We're just not going to go there. And then I would say, apparel and fashion, right? Return rates are high. Typically, trendy type products. We look at staples in apparel and uniform sizing, but in general, right? Everybody orders two pairs of everything when they're shopping for clothes online. I know shoes have like 30% return rates. It's insane. So those are the main 3 areas. But other than that, we're open.
Rob, what about you outside of supplements? What do you?
Yeah, I think the other one is like sexual wellness products. We obviously see a few of those. Weapons, accessories. So I think if someone's launching a business with the idea of exiting it, like try focus on consumer staple products that are defensible. But don't be afraid to go into kind of weird niches. We own some pretty exotic products, but they're still kind of not classified in those things that we just mentioned.
Cool. Brandon, any final words from you before we go?
No, it's good stuff. Really appreciate having us, Danny. No problem. Thank you for coming on and being so open. I know that last week kind of blew the doors open on some areas, and I thought it'd be a good chance for you guys to say your piece. And you've been very open and candid. So.
Nothing we haven't heard before, Danny.
Of course not. Look, at the end of the day, people it's a divide and conquer way of doing things as well, I suppose, right? You come in, you shake up the market. We have the course wars and stuff, and now we're going to have the aggregator wars. Some will be at war and some will just lead. And then, as they say, criticism comes from underneath, not from the top. And if it does come from the top, it's good fucking PR. So I'll finish on that. Rob, what's the best way that people can reach you?
Yeah, just shoot us an email, rob@elevatebrands.io, or just drop us a line on our website, elevatebrands.io, and we'll be at Prosper. So looking forward to seeing everyone. Yeah,
I'll be making some Prosper announcements soon now. I've started to close some stuff in the next couple of weeks. So we'll see all you guys at Prosper. Ken, best way to reach you?
Same, Ken at Thras.io, LinkedIn, Facebook, our website, which I think we just transitioned over to .com finally. Because people are calling us.
It'll get there. It'll redirect anyway. Brandon, best way to reach you?
Yeah, same Brandon at Thras.io or at Thrasio if it's finally working, which would be nice.
Cool. Guys, thank you so much for joining us today. Guys, tomorrow, Sharon Evan will be back in the chair. Isabella be here Monday. So take care of yourself and your family. Much love, and I'll see you next week.